A friend of mine I'll call Joel sent me a text last spring that I haven't been able to stop thinking about. He'd just gotten his W-2 in the mail, his wife had gotten hers, and the combined number for the year had crossed $150,000 for the first time in their lives. The message was 4 words long. Why don't we feel rich? I sat with that question for a couple of weeks before I gave him a real answer, because the honest version of it turned out to be more useful than the easy version. The easy answer is the one every personal finance video gives. You're spending too much. You're not saving enough. You bought the wrong car. None of that is technically wrong. It's just shallow, and it doesn't actually explain why somebody earning real money still feels like they're treading water. The real answer is that $150,000 of household income is a specific zone with its own specific rules, and most people who arrive at this number arrive at it by playing the $80,000 game with a bigger paycheck. They didn't update the playbook. The apartment got upgraded when the new income arrived. The car got upgraded a year later. The takeout habit drifted in somewhere between the two. And the financial reflexes that worked when the margin was tighter kept running on autopilot. And the game changes at $150,000 in ways almost nobody is warned about in time. That's what this video is about. 5 specific rules that change once you cross this income, and why almost nobody hears them until it's later than they'd like. I'm Tom. This channel is about real personal finance for normal people. No motivational fluff, no fantasy returns. Just what the math actually does over time. If that's what you want, hit subscribe. One piece of context before we get into the rules. $150,000 of household income puts you well into the top quarter of American households based on the most recent census data. That's objectively affluent. You earn more than 3 out of 4 households in the country. So when Joel and his wife asked why they didn't feel rich, the answer wasn't that they shouldn't feel that way. The answer was that the system is set up to make this income level feel exactly the way it feels, and you have to do specific things to break out of that feeling and actually build wealth at this number. Here are the 5 things. Rule 1. Know your real take-home. The first thing almost every household at this income gets wrong is that they think they earn $150,000. They don't. They earn that number on paper. What they actually have to work with is something significantly different, and most people never sit down and calculate the gap. Let me run it for a married filing jointly household at this income with the 2026 tax brackets. Roughly $30,000 goes to combined federal income tax, FICA, and state income tax before anything else comes out. Another $20,000 or so goes to health insurance premiums and a reasonable 10% retirement contribution across both spouses' 401ks, which mostly come out pre-tax. By the time all of that settles, the cash actually landing in your checking account across the year is somewhere around $100,000. $100,000. That's the number Joel and his wife actually have to operate from, not 150. The first rule of the 150,000 game is to mentally anchor at the take-home number, not the gross, because the two numbers produce 2 completely different sets of decisions. When you make plans assuming you have 150,000 to deploy, every month feels like a miss, because reality keeps coming up 30 or 40% short of the number in your head. The fix is unglamorous. Sit down once a year, in late January when the W-2s arrive, and write down your actual take-home. Not your gross, not your AGI. The cash that actually enters your accounts after every legitimate subtraction. That number is the budget you're working with, and once you anchor on it, everything downstream calibrates correctly. The bills feel proportional to the income that's actually paying for them. The savings rate stops feeling like a moving target. Joel told me later that writing down his real number was the first time in years that the financial conversation in his marriage stopped feeling defensive on both sides.
Rule 2. The lifestyle wedge.
Here's what happens to almost every household when they cross into this income range. The raise lands. They sit with it for a minute. They tell themselves they're going to save it this time. And then, over the next 6 months, the lifestyle quietly absorbs every dollar of it, and the saving never happens. It tends to go like this. A new car payment shows up because the old car was technically due for replacement, and the math on the new one looked workable. The apartment moves up a tier because the kids are growing and the old place feels small. Takeout that started as a treat becomes the default plan 3 nights a week. The kids' activities multiply because at this income, you can technically afford the soccer plus the music plus the tutoring. Each decision looks like a reasonable choice somebody at this income should be able to make. The cumulative effect, 6 or 8 months later, is that the raise is gone. The bank balance hasn't moved. The lifestyle has expanded to match the new income with disturbing precision, and the wealth building hasn't accelerated by a single dollar. The fix for this is mechanical, not motivational. Before the raise lands, you pre-decide what percentage of it goes to investments and what percentage flows into your lifestyle. My default recommendation for a married filing jointly household in this income range is 70-30. 70% of every raise gets automatically routed to investments before it ever lands in your checking account. The other 30% goes into your lifestyle, and you don't feel guilty about it because it was planned. If you're single at this income level, you can usually push the ratio harder, somewhere closer to 80-20, because your fixed life cost base is smaller. For a family household, 70-30 is high enough that wealth building accelerates with income growth, and low enough that life still feels like it gets a little better each year. The single biggest predictor I've seen in my own friends about who builds real wealth at this income and who doesn't is whether they had this allocation rule in place before the raise arrived, or whether they tried to figure it out after the money hit their account. By the time it hits the account, the answer is already eaten. The conversation has to happen at the offer stage, ideally written down somewhere, ideally automated into the 401k deferral percentage and a separate brokerage auto deposit. Anything less than that, and the lifestyle wins. Rule 3. Boring beats clever. This rule is the hardest one to internalize at this income level, because at $150,000, you start to have enough money sitting around that clever strategies become tempting. You also start to have enough disposable income that you can afford to lose a chunk of it without it immediately wrecking your life, which is exactly the situation in which people make the worst financial decisions. The pitches start arriving. Real estate side hustles managed through some app you've never heard of. Options trading. Cryptocurrency strategies a colleague swears by. Individual stock picking dressed up as research. Covered calls and leveraged ETFs that come with 3-page disclaimer footnotes. Private placements your cousin's friend is running. Tax shelters that someone on a podcast described as a no-brainer. The implicit message in every one of these pitches is that boring index funds and maxed retirement accounts are for amateurs. And now that you've reached real money income, you should be doing real investing. That's a trap, and here's why. At $150,000 of household income, your contribution rate is the dominant variable in your wealth trajectory by a wide margin, well above your return on investments, your tax strategy, or your asset allocation combined. The difference between contributing 10% of your income and 25% of your income to your retirement accounts will produce dramatically more wealth over 30 years than any clever strategy you could deploy on the dollars you've already saved. The difference between an 8% return and a 10% return is real, but it is vastly less impactful at this income than the difference between contributing $20,000 a year and $35,000 a year. So at this level, Your strategy should look almost embarrassingly boring. A small handful of broad market index funds.
Maxed retirement accounts in the right order.
If you have access to a health savings account through a high deductible health plan, that gets maxed too. Set the whole thing on autopilot, increase the contribution rate by 1% every January, and walk away. Anything more elaborate than that at this income is more likely to leak money than to make it. The clever strategies people pitch you at this stage are usually designed for people with 20 million in investable assets, where the marginal tax efficiency of complicated moves actually matters. At 150,000, you're paying yourself to be cleverer than you need to be. The bill comes out of your retirement. Rule 4. Cash buffer should match your burn rate. Standard advice on emergency funds is 3 to 6 months of expenses. The advice is correct. Most people at this income apply it wrong. Here's the mistake. When you earn 150,000, the temptation is to think of your emergency fund as a percentage of income. So 3 months of 150,000 sounds like 37,000. 6 months sounds like 75,000. People at this income often hold one of those numbers as their cash target, sometimes higher. That's the wrong frame. Your emergency fund should match your monthly burn rate, which is what you actually spend, not what you actually earn. If Joel and his wife earn 150,000 but spend about 9,000 a month on their actual lifestyle, including housing, food, kids, utilities, and everything else, their 3-month emergency fund target is 27,000, and their 6-month target is 54,000, not 75,000, not the bigger numbers scaled to their income. This matters in both directions. The people who scale their buffer to income tend to overhold cash, which costs them in long-run drag and tends to dampen their investing discipline. The people who underhold cash relative to their actual spending end up in trouble during the first real emergency, because the buffer they thought was generous turns out to cover 6 weeks of their lifestyle instead of 3 months. The right number is anchored to what you actually spend in a typical month, calculated honestly, including the irregular stuff that hits a few times a year, like car insurance and registration, and the dental work and the school fees. Multiply by 3 for the floor, by 6 for a comfortable cushion. And the most important part is that you adjust this number when your spending changes, not when your income changes. A raise doesn't require more cash on hand. A bigger lifestyle does. A lot of households at this income drift in the wrong direction on this one for years before they catch it. Rule 5. One income funds life, the other funds wealth. This last rule is specific to dual income households, which describes a clear majority of the families at this income level. Most couples at 150,000 combined are getting there through 2 paychecks, not 1. The structural rule for these households goes like this. Your goal is to set up your finances so that one spouse's income fully funds your life, and the other spouse's income essentially funds your wealth building. That doesn't mean one paycheck gets a special account. It means your monthly budget should be designed so that one paycheck would cover essentially everything you need to live on, and the other paycheck functions as excess that gets routed to investments more or less automatically. If you can come close to this structure at 150,000 combined, the math accelerates dramatically. In a household at this combined income, after the full tax burden is accounted for, one spouse's 75,000 paycheck contributes roughly 55,000 of after-tax money to what the household actually has each year. If most of that flows into investments instead of into the household budget, you're building wealth at a rate of 45 to 50,000 a year. 25 years of that, at a 7% real return, lands somewhere around $3 million. The other paycheck, meanwhile, funds the actual life, which means the actual life doesn't have to feel constantly squeezed. If you can't make this structure work at 150,000 combined, that's actually useful information, because it tells you exactly where the structural problem in your finances sits. Usually the problem lives in one of 3 places: Housing is eating 35 or 40% of gross when it should be 25 or less. Childcare and after-school costs are running $30,000 a year and have never been optimized. The third common one is being car poor, with 2 vehicle payments running $1,500 a month combined. The structural problem has to be solved at the layer where it lives. You cannot out-invest a bad housing decision at this income, and you cannot out-budget a childcare math that has gotten out of hand. For households in high cost of living areas, the one income funds life version of this rule is more aspirational than achievable. The honest version, in that case, is to get as close as the math allows. Maybe one income covers 80% of expenses, maybe 70%. The closer you can get, the faster the wealth builds, and the structural fixes that get you closer are almost always more valuable than any investment tactic. This single piece of architecture, when it works, is the cleanest way I know to escape the feel broke at 150 trap that most households at this income spend years inside. Here's what I ended up telling Joel and his wife at dinner last summer when we finally walked through their numbers together. The reason they didn't feel rich at $150,000 was that they were playing the $80,000 game with a higher score. They had not updated their rules to match their income. They were carrying a cash buffer scaled to their gross instead of to their actual spending, which left $30,000 sitting in a checking account doing nothing. They had no automatic raise allocation set up, so their last 2 raises had quietly disappeared into the lifestyle without a trace. They were seriously considering a short-term rental side hustle that would have been a 6-figure distraction from the things that were actually going to build their wealth. And their housing was eating 38% of their gross, which was choking everything downstream. 6 months later, they'd implemented 4 of the 5 rules. The housing situation is harder to fix immediately, and that part is still in progress. But their cash buffer is now right-sized to their burn rate. Their retirement accounts are fully maxed for the first time in their working lives. The next raise is pre-allocated at 70-30 before it lands. And they stopped looking at clever strategies that weren't going to move the needle at their level. What changed for them wasn't earning more money. They actually earn about the same now as they did before. What changed was that they started playing the right game for the income they already had. If you want me to walk through the specific account types and tax efficiency moves you should be running once you've got the architecture right, I made a video on this channel called The Smartest Order to Invest Your Money that covers the full sequence. Watch that next. Drop a comment with your current household income and which of these 5 rules you realized you've been getting wrong. I read every one. Hit subscribe. I'll see you in the next one.